December 12th, a Friday, a date that sounds ordinary, but inside the Federal Reserve's data terminals, it's already circled in red. Because on that day, the Fed's next liquidity window quietly opens. It won't be announced with fanfare. No press conference. No primetime headline. But deep within the Treasury General Account and the New York Fed's balance sheets, hundreds of billions of new dollars will start flowing into the system again. They won't call it money printing. They'll call it liquidity operations or balance sheet adjustments. The kind of technical language designed to make the biggest financial event of the year sound harmless. But make no mistake, this is the same playbook that lit the inflation fuse in 2020. And the warning signs are already visible. For months, Chair Jerome Powell insisted that quantitative tightening, QT, would continue until inflation was under control. But inflation never truly went away. The Consumer Price Index sits stubbornly near 3.5%, core inflation above 4%, and yet the Fed's balance sheet, supposedly shrinking, has stopped falling. Between September and November, over $450 billion quietly re-entered the system through reverse repo rollbacks and Treasury buybacks. That's liquidity. That's money creation. And the timing, right before December 12th, isn't a coincidence. It's deliberate. The real decision makers aren't just Powell or the FOMC. It's the network that connects the Fed, the Treasury, and the primary dealers, banks like JP Morgan, Citigroup, and Goldman Sachs. They execute the trades. They distribute the liquidity. They manage the reserves that move markets. When the Fed restarts the printing cycle, they're the first to know and the first to profit. Behind closed doors, this coordination is called monetary fiscal alignment. But alignment is just a polite way to describe controlled inflation. Here's the real reason December 12th matters. The Treasury is about to issue another $1.3 trillion in new debt over the next quarter to fund spending and roll over maturing bonds. Foreign buyers, Japan, China, and Saudi Arabia, have already reduced their Treasury holdings. That leaves the Fed and U.S. banks as the buyers of last resort. So when Powell says liquidity support, what he really means is, we're going to create new money to buy our own debt. It's not theory, it's necessity. And it starts this Friday. The public will never see the switch flip. There will be no ticker, no breaking news banner. But if you look at the Fed's balance sheet update the following week, one number will jump: reserve balances with depository institutions. That's where the new money lives. It will flood into banks, then into repo markets, then into equities, and weeks later, prices will rise again. Not instantly, not explosively, but inevitably. Because every dollar the Fed creates has to find a home. And when it does, it finds you, at the grocery store, at the gas pump, in your rent. The printing press is turning back on. And this time, the inflation won't be a shock, it'll be a policy. The Federal Reserve doesn't print money with ink anymore. It does it with keystrokes. When the Fed adds liquidity, it credits the reserve accounts of major banks at the New York Fed. These reserves are not physical dollars. They're electronic liabilities that can be instantly lent, leveraged, and recycled through financial markets. In other words, when the Fed creates money, it starts at the top of the pyramid. The new money doesn't go to households. It doesn't go to small businesses. It goes to banks, broker-dealers, and hedge funds, the entities that connect to the Fed's liquidity pipes. From there, it spreads through what economists call the transmission mechanism, a polite phrase for the most complex financial web in the world. Every night, U.S. banks lend and borrow roughly $2.5 trillion through a market called the overnight repo market, the plumbing of global finance. Here's how the web works. Banks use Treasury bonds as collateral. The Fed uses repos to inject cash into the system when liquidity gets tight. In return, it receives those treasuries temporarily, expanding its balance sheet without technically calling it QE. It's quantitative easing in disguise. The repo market is the hidden front line of every money printing cycle. And on December 12th, that line lights up again. The New York Fed's own schedule shows new operations beginning that week, including term repos and Treasury buybacks. That's not coincidence, it's coordination. Now enter the U.S. Treasury, the government's checking account, known as the TGA, Treasury General Account. When the Treasury spends on defense, infrastructure, or entitlements, it draws from that account. But here's the catch. The only way money enters the TGA is through debt issuance, Treasury bonds. So every new dollar the government spends must first be borrowed. And when buyers dry up, the Fed steps in, indirectly, through primary dealers. They buy the bonds. The Fed supplies the cash. Money is created out of thin air, passed through two hands, and recorded as market activity. It's a cycle so seamless that even economists argue about where debt ends and money begins. But this web doesn't end in Washington. It stretches across the planet. Central banks in Europe, Japan, and China all hold U.S. treasuries as reserves, nearly $7 trillion worth. Those treasuries are the foundation of the global financial system. If the Fed doesn't keep their prices stable by supplying liquidity when yields rise too fast, the entire world's dollar system starts to wobble. That's why this money printing isn't optional. It's not stimulus, it's maintenance of the empire. Every country holding dollars is trapped in the same web. If the Fed stops printing, their reserves lose value. If it prints too much, their currencies weaken. Either way, the Fed remains the center of the wheel. When you hear the phrase, the Fed is shrinking its balance sheet, look closer. Every dollar drained from one pocket is often reintroduced through another, whether through repo lines, discount windows, or treasury facilities. It's like draining a pool while filling it through the hidden pipes underneath. The net result? Liquidity never truly leaves the system. It just moves, hidden beneath acronyms like RRP, Reverse Repo Program, SRF, Standing Repo Facility, QE Lite, Treasury Buybacks, BTFP, Bank Term Funding Program. Each one sounds technical, but they all mean one thing: more money entering the system quietly. From the outside, it looks like the Fed is making careful, data-driven decisions. But behind the scenes, these operations are automated. The system must create liquidity just to stay balanced, like a shark that has to keep swimming or suffocate. Every dollar printed in December is already accounted for in someone's spreadsheet, someone's derivative, someone's expected yield. There's no manual override, just constant calibration. That's why when the Fed restarts printing, it's not a decision. It's a reaction. So when the press release comes out that Friday, it will sound boring. The Federal Reserve conducted routine open market operations to ensure smooth functioning of financial markets. But behind those sterile words lies the spark of the next inflation wave. Because every liquidity injection eventually leaves the financial web and enters the real world. Groceries, rent, energy. The web may start in Wall Street terminals, but it always ends at Main Street checkout counters. The money never disappears. It just changes names. Every few years, the Fed promises the same thing. This time, we'll normalize. They'll raise interest rates. They'll shrink the balance sheet. They'll restore discipline to the system. But every time they try, something breaks. In 2019, it was the repo market, when overnight lending rates spiked to 10%. In 2020, it was corporate debt and money market funds. In 2023, it was regional banks drowning in losses from rising bond yields. Each time, the Fed steps back in, injects liquidity, and the cycle resets. Printing money isn't a strategy anymore. It's the operating system. Think of the economy like a patient on life support. Liquidity is the oxygen. Take away too much, and the patient flatlines. That's what happened in March 2020, when the global system froze overnight. The Fed printed $3 trillion in just 3 months. Markets recovered instantly. Everyone cheered. But in the background, something irreversible happened. Wall Street learned that crisis equals stimulus. Every dip became an opportunity to front-run the next wave of money printing. And that mindset, the Fed will always step in, became the foundation of modern finance. The problem is, you can't print without consequences. From 2021 to 2023, inflation surged to 40-year highs. Energy, housing, food, all spiked. The Fed fought back with the fastest rate hikes in modern history, raising the federal funds rate to 5.5%. But now, as the economy slows and debt costs explode, they're cornered. If they print, inflation rises again. If they don't, markets collapse. That's the trap. There's no safe option left, only trade-offs between pain now or crisis later. The Fed's balance sheet sits near $7.5 trillion. Each trillion represents promises, treasury debt, mortgage bonds, and bank facilities that can't simply be unwound. Every time the Fed sells assets, yields rise. When yields rise, the government's borrowing costs explode. When that happens, deficits widen, and the Fed has to print again just to stabilize treasury markets. They've built a self-reinforcing machine. Printing causes inflation. Inflation forces tightening. Tightening breaks markets. Market panic forces printing again. It's not a conspiracy, it's arithmetic. The U.S. government now pays more than $1.1 trillion per year just in interest on its debt. That's more than the annual defense budget. And as long as rates stay high, that number keeps climbing. So the pressure builds. Congress needs the Fed to ease. Banks need the Fed to ease. Markets expect the Fed to ease. Which means printing, whether through QE, repo facilities, or buybacks, isn't a temporary measure. It's a fiscal necessity disguised as monetary policy. The Fed has become the buyer of last resort, not because it wants to, but because nobody else can absorb that much debt. Adding to the trap is the automation of money itself. Algorithmic traders now treat Fed policy like an input variable. When Powell speaks dovishly, markets rally instantly. When he sounds hawkish, markets crash, forcing the Fed to reverse tone. The algorithms have learned the cycle, and now they reinforce it. The Fed can't tighten without triggering panic, and panic triggers the very interventions they were trying to avoid. Human control has been replaced by feedback loops. The free market has become a coded reflex. The system didn't set out to become this fragile. It evolved this way, slowly, naturally, through decades of crisis management. After 2008 came QE1. After 2011 came Operation Twist. After 2020 came QE Infinity. Each phase promised an exit. None delivered one. Now, the entire economy runs on confidence that the Fed can manage the unmanageable, that it can print without consequence and tighten without breaking things. But as December 12th approaches, the same cycle is repeating. Liquidity will rise, prices will follow, and faith in the Fed will once again be tested. The system can't function without constant money creation, but every new dollar pushes inflation risk closer to the surface. So the real question isn't when the Fed will print again. It's how long the world will keep believing it can do so forever. Cynthia Reed, a single mother in Columbus, Ohio, works 2 jobs. Her paycheck is the same as last year, but the receipt at Kroger isn't. Milk, $5.29. Eggs, $4.19. Ground beef, $8.49. She doesn't know about the Fed's balance sheet adjustments. She just knows the dollar in her hand feels thinner. Every time Washington adds liquidity, prices down her street quietly climb. Her grocery cart is the final stop of the liquidity pipeline. Across town, Mark Jeffers owns 4 rental houses bought with low-interest loans during 2020. Rising rates should have hurt him, but they didn't, because asset prices never fell far enough to reset the market. His property values ballooned again in 2024 after the Fed's first temporary support. He's richer on paper, yet his tenants are drowning. When they ask for a rent break, he blames the market. He's not wrong. He's just repeating what the Fed's liquidity made inevitable. At JP Morgan's headquarters, Ryan Miller stares at the repo screens glowing green. He knows the December 12th operations will flood short-term funding markets. His team will profit. The firm's quarterly numbers will look solid, and CNBC will call it stability. But Ryan also tracks inflation swaps. They're starting to tick higher again. An early whisper that the liquidity wave will leak into consumer prices by spring. He can't say it publicly. The narrative must stay calm until the cycle completes. In Tampa, Angela Moreno, 72, checks her bank statement. The interest on her savings account finally rose after years near zero, but so did her property tax, insurance, and groceries. She doesn't understand why her money feels like sand running through her fingers. Every policy announcement she hears, maintaining market functioning, ensuring smooth treasury operations, translates into one reality. Her fixed income buys less each month. We've been here before. In the 1970s, after Vietnam and the oil shocks, the U.S. printed heavily to fund deficits and cushion markets. Inflation hit 13%. The dollar lost half its value against gold. The phrase cost of living adjustment became a lifeline for millions. It ended only when the Fed, under Paul Volcker, chose pain over illusion, raising rates to 20% and forcing a deep recession. It broke inflation, but nearly broke the system itself. Today's Fed faces the same moral equation. multiplied by debt 10 times larger. Volcker fought inflation with debt at 30% of GDP. Powell faces it at 120%. Printing again may delay the reckoning, but it also ensures that the next Volcker moment will be far harsher. Look further back, to the Roman denarius, slowly debased until silver became tin. Or Weimar Germany, where emergency printing to protect citizens ended with bread costing billions. Or Britain in the 1950s, managing post-war debt through inflation that quietly halved the pound's value in a decade. Empires rarely collapse. They erode through money that loses memory. Each believed they could manage the process. Each believed printing was temporary. None could stop once dependence set in. Cynthia's grocery total, Mark's rising rents, Ryan's liquidity screens, Angela's shrinking savings. They're all expressions of the same policy written in different handwriting. When the Fed restarts its programs on December 12th, it will be hailed as technical support. But history will record it as another turn of the spiral, one more proof that a system built on liquidity can't live without it. The last time this pattern appeared, the cure required a decade of austerity and interest rates few people today could survive. So the real suspense isn't if inflation returns. It's how far the Fed will go to deny it before admitting they've lost control. When the headlines roll out on December 12th, they'll sound reassuring. Fed conducts temporary operations to support market liquidity. Official stress move is not a return to quantitative easing. Investors will cheer. Stocks will jump. Bond yields will settle. For a few weeks, it will look like stability. But the truth is simpler and darker. Every time the Fed intervenes to calm markets, it pushes the underlying problem further into the future and makes that future harder to control. Printing works until the consequences show up where the data can't hide them. In rent, in groceries, in insurance premiums, in trust. Inflation doesn't announce itself in breaking news banners. It erodes slowly, like humidity warping a floorboard. You notice it when a $20 bill no longer covers takeout. When your car insurance renews 30% higher. When savings that once felt safe now feel like melting ice. These are the aftershocks of technical operations. You can't see the trillions being created, but you can feel their weight in the shrinking power of every paycheck. By spring, data will show inflation ticking up again. Officials will call it sticky or transitory. Markets will bet on another round of tightening, which will cause credit stress, forcing another wave of easing. The system is now a loop with no real off switch. Print, inflate, tighten, break, print again. The only variable that changes is how long it takes to go full circle. December 12th will mark the next beginning, not the end, of that cycle. Cynthia, the mother in Ohio, won't know the date or the reason. She'll just know that by March, her grocery bill is $40 higher. Angela in Tampa will stretch her retirement again, wondering why the economy is strong, but her wallet feels weaker. Mark will refinance his properties, locking in gains that exist only because money itself keeps multiplying. And Ryan, the analyst, will trade another liquidity rally, knowing it's built on air, but too profitable to ignore. Each is playing a role in a story they didn't choose, a story written by spreadsheets, interest rate models, and the quiet hum of digital money being created on command. Every generation believes their money is different, but the laws of arithmetic don't change. You cannot print value into existence. You can only move it, from savers to borrowers, from wages to assets, from the present to the future. The Roman emperors thought they could manage debasement. The 1970s Federal Reserve thought inflation could be fine-tuned. Each time, the correction came, harder, faster, and with fewer options left to soften the blow. If this cycle follows history, the moment of reckoning won't come with a crash. It will come with a quiet realization. The dollar still exists, but its meaning has changed. We can't control what happens in the Eccles building, but we can control what we understand. Knowledge is insulation. You don't fight the system by panicking, you outsmart it by preparing. You study where liquidity flows, what assets survive inflation, and how to hold real value when printed value floods the system again. Because when everyone else hears stability, those who understand what that word really means will already be moving differently. December 12th won't feel like a historic day. There won't be an announcement, or a siren, or a signal. Just a few lines from the New York Fed, and a quiet injection of liquidity into the bloodstream of global finance. But history may remember it as something more. The day the Fed stopped pretending it could ever stop printing. The illusion of control will hold, for now. But behind it, the same old math keeps whispering the same old warning. You can delay reality. You can't delete it. So ask yourself, if money itself can be created at will, what still holds real value? What remains yours when everything else depends on someone's balance sheet? Because the next decade won't be about how much you earn. It'll be about how much of what you earn still means something. This was Fed Money Printing Starts on December 12th, Inflation Warning. If you found this eye-opening, share it, because the system runs on silence, and the only real hedge against silence is understanding.